2 to 3 years from now, when you're in more stable market, my conversation will be different. Maybe so higher cash flowing deal, I might focus on more new development. But at this point, it's a beautiful opportunity to be buying these assets and getting in with very low basis. And irrespective of what you're thinking of volatility, you have to bring it down to simplicity, supply and demand. What's happening in the next 2 to 3 years? We are going to be an undersupply market. No one can deny that, no one can change that. And that's that opportunity where we want to be.
Hi, folks. My name is Akash Jain. I'm the host of Next Gen Wealthcast, and I'm very excited today to welcome my dear friend Nishant Sondhi to the podcast. Nishant, welcome.
Thank you, Akash, for having me here. I'm super excited.
Nishant is coming to us all the way from Gurgaon, India. He's there visiting his family, and Nishant, I thank you for making the time to visit with us. Let's not keep our audience waiting. Let's dive right into it. You and I have met each other a number of times on a lot of conferences. I love your story. I love your story on how you have expanded your network and have gone from just being a limited partner to being a general partner and participating in a number of deals. I want our viewers to learn from that. I want our viewers to be able to relate to that. Walk us through your story, your background, and how you're successful with what you're doing right now.
Love to share my story. I was actually born in the US, but when I was 4 years old, 3 or 4 years old, that's when I moved to India. I pretty much grew up in India. That's where I did my education, both undergrad and postgrad. And in 2018, I moved to New York City. And within 12 months only of moving to New York, and I was just very inspired being in the city that I decided to become a real estate broker, salesperson. And I felt that entering the real estate business, being a real estate broker, was probably the fastest and easiest path over there, just from a cost perspective. Also, I've always had a sales and entrepreneurial background, so I felt that this is something I could leverage in terms of experience. Of course, I grossly underestimated how difficult it can be, not just in terms of competition and the timeline of the sales and pricing, right? Of course, we look at New York City home prices and we get a lot of new folks entering the industry get excited, but the sales cycle is also a lot longer than other markets in the country. And COVID happened. So 2019, I became a real estate broker. 2020, COVID happened. That was the time when I was really building. COVID was I could say, some setback for me because I really built a good platform in 2019, which I felt that during the springtime in 2020, I could really benefit from. But it's only by the end of the year, all my efforts came into one place. I started take coaching, and by 2021-22, I really started to grow my practice, and that's when I got success, built a network, primarily folks working in tech, finance, consulting, Fortune 500 executives living in New York, New Jersey, or Connecticut, looking to buy into Manhattan. It's very specific market that I was focusing on. But it's late 22, I realized that I was looking to build a family. And while New York City real estate was exciting, it's also a lot of work being a real estate agent. A lot of time over the weekends can get spent showing properties. Scalability is an issue which I felt. I thought I will be very limited to the market, and I was really interested in entering the private equity side of the business, and mostly multifamily really excited me. Late 22, early 23, slightly north of 2 years, that's when I started leverage my network. I worked for 6 months with a private equity company in Florida. Before, it's been a year and a half now that I started my own fund. I've worked with almost 100 investors now directly with my funds, about 15 deals so far. So it's been an exciting journey, I would say, and I really enjoy what I do. Of course, there were different risk elements at every time because when I started off as a real estate broker, immediately after coming to the US within 12 months and then COVID, and then I started a real estate fund, and within a few weeks, I got to know that my wife's pregnant. So both journeys were probably at risky times.
Very cool story. Hey, congratulations on the baby. I know the baby is about
Thank
10
you.
months old now.
Yes, he's 10 months old. So it keeps us really busy and enjoying this space. It actually changes so much your thought process so much, and you actually realize more and more the value of real estate investing in general, and just feel very grateful.
Very cool. Hey, that kind of links with some of my why, Nishant, is also, hey, family. right? And my why is a family. What I do every day is family, kids, some financial freedom, if you may. So that gels very, very well. And that actually also kind of brings us to my next point around generational wealth, create generational wealth. My fund is called, you know, multi-asset generational, talking about different asset classes and creating generational wealth. That's the motto of my fund. Now, you just talked about 15 deals in about 18 months time frame with 100 plus investors. Tell us a little bit about any asset classes that you focus on. Hey, I obviously delve into a different, little, from a diversity perspective into multiple asset classes. Talk to us about the asset classes that you dive in, that you invest in, that you like, that you maybe want to explore.
Sure, that's a great question. And a lot of it comes from understanding my networks or client bases problems, right? So to start with, if you take a step back, my clients were having, that extra 50, 100, 200K, and they're looking at diversifying into, let's say, real estate and outside the typical public markets. But what were they trying to solve for? They're trying to solve for cash flow. They're trying to solve for growth and tax benefits as well, right? So just keeping my experience previously as a real estate broker, I felt that real estate came to me a lot more naturally, right? I also read a lot of books, podcasts. And so I started off with multifamily and built to rent and multifamily, mostly into value add multifamily, because just as I mentioned, I felt this asset class really covers all three areas: cash flow, growth, and tax benefits. Okay, something and from a risk adjusted reward basis, it makes a lot more sense, right? It's a proven asset class. You're going to see that the risk element also, what I felt, is a lot more in control once you do the due diligence and the fundamentals are in place. But having said that, as I started to build and grow my network, I understood that people may want one particular area and want to solve more for that. For example, some investors want more cash flow and tax benefits. Then I started to look into oil and gas. Then some investors more focus on growth. Then I looked more into new developments in real estate or a private equity deal, which I've done. So primarily, my focus area is and will be real estate because, as I mentioned, it covers many different areas that I'm looking to solve for. However, I'm open to different asset classes depending on the partner who I'm working with and the experience to introduce to my investors. It should solve something for them. That's the key. I need to solve problems for them.
Very cool. Thank you so much for that great answer, Nishant. One of the things that also hey brings to the forefront in this discussion is also when you're looking for deals. Hey, how do you do your due diligence on the sponsors? How are you making sure that your investors' money is going to grow and be safe? Hey, talk to us a little bit about the whole process that you go through when you're vetting a sponsor and you're doing your due diligence, and then you take money and invest. How do you make sure that that money is safe?
Well, that's a great question, and um, so just to put it out there, I work with a very limited pool of sponsors. Okay, just to start with, and the reason being, it takes a long time to build a relationship for you to get comfortable, right? So it takes time to not only review the sponsors' past deals, meet them in person. I have personally visited the apartments where we've invested and seen investments done by my sponsors to understand their business plan, their strategy, and just spend enough time before you actually look into a deal and you invest. So a lot of backwork goes in. I know that's more slightly more for qualitative answer, but I like to keep it more focused to a smaller pool. Now coming more in terms of the meat of really where the deal goes. Once you build that confidence in the investor, you also get to know some standards like they like to maintain for the deals. Like, for example, the interest rate strategy or certain loan strategy, which they have a percentage of loan to value, which they're looking at, or what's the occupancy rate they're going to look at. So as you build that relationship, that comfort also starts coming in. But largely speaking, we do background checks on our sponsors before we start working with them on a regular basis. Before, even if it's the fourth deal I'm doing with the sponsor, to ensure that there's that one check over here. At the same time, we also do due diligence in terms of the underwriting. Now, my experience as a real estate broker really comes handy here because I've had a huge part of my job has always been coming up with good pricing based on comparative base sales. So I would say my past experience of looking into rental comps, sales comps to identify correct pricing as well as projections are pretty handy because I've done that previously as well. Apart from that, we also do have legal help where we want to make sure, while of course you can review any private placement memorandum, it's really important to know that where we stand in that capital stack as compared to other limited partner investors, as compared to the general partners, how are we protected over here in case of any downside. That legal expertise I don't have, and we like to only outsource it. Over and above any other property inspection reports, which are checked by us as well to verify a mix of all of this. Now I don't typically do all of this on my own. Now what can happen is that the certain elements can be outsourced. So I do have someone who helps me with the underwriting. For legal, I'm part of different groups like Investor and Connected Capital. So it's very powerful when other fund managers come and collaborate with you as well. So I think it's a very a good combination of all of these, along with some physical due diligence, really gives that kind of confidence. And I feel like it's only recently that I've started to mix up my asset classes. So the deals I'm doing this year a lot more than last year. Of course, last year was my first full year, but this year I realized that there's some investors, like I mentioned, are optimizing for cash flow. Someone's really looking at growth, and you can still have two or three deals going together.
Very cool. And that brings me to another question around the deals this year, right? 2025, we are almost middle of the year. Hey, 5 months into it. Hey, I have been looking at deals and nothing makes sense right now. If I'm getting a good deal, then I can't get a good financing on it. If I'm getting good financing, then it's not a really good basis. And so I'm still scratching my head. I haven't done any deal this year. Last year, by this time, I had done 4 deals. And so I want to take your, take your advice on, hey, what are you looking at in deals this year? What are the deals that you've already done this year? How are they looking like? And what is some of the economics, if you may? And as the interest rates keep playing hide and seek with us, what are you looking forward to in the remainder of 2025?
Sure, those are great questions. And I think largely being a capital allocator and an investor myself, I primarily see my job first as a risk manager, but second, also having that potential to be looking at various different deals because, of course, I do get different opportunities coming across to me. As I mentioned, I work with a smaller pool of sponsors, but they typically do have deals coming up quite regularly. But just to give you some context, what I've done this year, I've done a build to rent asset class in Centerville, Ohio, which is between Dayton and Cincinnati. I'm a huge fan of the build to rent asset class just because I feel that's a trend which is going to pick on over here, where we have single family rental houses, where residents have private lawns, private garage, but also multifamily apartment community. The benefits of that by having clubhouses, tennis clubs, dog parks, etc. Because end of the day, you're not as cramped as a typical multifamily complex, but you also have more space and the feeling of living in a single family. So I did that investment backed by a lot of macro trends which I saw where Wall Street's investing billions in the sector, including Blackstone, JP Morgan, and I found a group which has done almost like 7 deals in this sector. So that is one asset class which I feel, it's not what you really go out and you look for. You just move with the trend, if I may say so. And I have done two value add deals, which are both in Charlotte last year. And those deals, essentially, which you're looking at are a couple of points, right? You want to look at a positive cash on cash as much as possible these deals can get. It's a bit difficult in this environment, but at least you can see some level of product market fit of 85 to 90% plus occupancy. And second is the basis, right? You want to look at what's the discount you're getting to recent comps, and at the same time the business plan. Whether what's exciting me a lot more at this point is, of course, that if they're distressed deals, but what's the upside potential? At least 50 to 60% plus apartments should be renovated. So did two of those deals. If I were to speak in terms of numbers, underwriting is still fairly similar as you were seeing at least 2 years ago, where the one is trying to optimize for a 15 to 17% IRR for a 5-year hold, most year 2x multiple on invested capital, with some cash on cash starting, if not year one, mostly from year two. So I won't say that's drastically different. What I'm educating my investors in terms is that real estate is a very simple business, and I know it might sound a bit controversial, but it's largely driven by supply and demand mechanics. Once you identify good markets, such as Dallas, where you're based out of, or Charlotte, or you can take Orlando, Houston, etc. Eventually, the job growth, population growth, the demand is only going up. And if there's not enough supply to service them in the next few years, it's going to lead to a market rebound, right? It's going to lead to a bounce market. Currently, we are seeing at least 30 to 50% lesser new developments, which are going to be hitting the market in the next 2 to 3 years, irrespective of what's going to happen with the mortgage rates. So, coming back to my supply demand point, that makes me a lot bullish for the next 2 3 years. So that's what I'm doing in value add. I'm looking at good bases. And I did a private equity deal in oil and gas. So it's kind of spread out. I didn't just do the real estate this year.
Very cool. Very cool. Hey, while we are in the thick and thin of this, I want also our viewers to get to know you a little bit. Let me
Of
throw
course.
in a question which might throw you off. Hey, Nishant, tell us about a karaoke song that you love and that you have dance moves to match with on.
Oh, karaoke songs really depends
A Hindi song would
which
work too,
time.
man.
Okay, I think a karaoke song would be depends which time of the evening we are really speaking. Just kidding. So it's I would say most popular songs. If I were, if I'm with my friends, okay, and we really have to go for karaoke music, we go into late 90s and early 2000s pop music as well. So we can even go back to listening to Hindi pop music by Shan, for example. I think that's really popular. We also go back to hearing Backstreet Boys when we're having fun. So, and then we always have the dance moves coming up. So I'm in the 90s and 2000s pop music era.
Very cool. Very cool. Hey, I grew up listening to some of Michael Jackson's and hey, some of these
Yeah.
old Indian Bollywood songs. So hey, that's
We
one of
miss
my
that
favorites.
now.
Yes, of course. And hey, you're in India right now. I'm sure you're enjoying a lot of good food. What's your favorite food?
So I love North Indian food, and my favorite has to be. It's just so easy. At least the previous question I had to think 2 3 times, but this comes directly. It's always going to be butter chicken for me, and chicken tikka for non-veg, and vegetarian would be chola bhatura. I'm from Delhi, so these are. If anyone is in Delhi, you must try this. Nice butter chicken with naan, the Indian bread, and a glass of Coke will always be my favorite.
All right. Hey, guys, if you're in Delhi, ever try Gulati's butter chicken. Gulati is my favorite in
Yes, of
Kandara
course.
Road. So, all right, awesome, awesome.
Really
That
good.
brings, hey, my mouth is already watering, man. Hey, thinking about that. All right, great. Now, question around, hey, when you are looking at oil and gas, Nishant, how did you come across oil and gas? Was it just by fluke, or were you looking for it? And why did you choose this asset class? I think you talked a little bit about it already about your investors, but give us a little bit more insight into, hey, oil and gas. How did you pick your operator around it?
Sure, that's a great question. So, I won't say I necessarily stumbled upon it. I do, like I mentioned earlier, I view myself first as an investor, being an allocator, right? So I'm looking at macro trends, and I want to fairly have a good picture of which direction the markets are moving in the next few years. So it was very clear that ESG private equity money is not falling into this sector as much as it needs to. And I read reports by JP Morgan that we're expecting a 7.1 million barrels per day shortage by 2030. So after reading a lot of these reports, I did understand that there is potentially an opportunity, but also my learning was that it's very volatile, right? So I wanted to be careful before I would really dabble into this kind of an opportunity. So I did meet an operator who I've been in touch for the past 2 years plus. They were tying up, partnering with a group who's specialized in this for the last 40 years, right? And their deal was a good mix of cash flow for existing wells as well as new drilling, so kind of the upside potential as well. What I was looking for are a couple of things. Firstly, like I mentioned, a strong track record, really important. Evidence of success of previous funds, once that has been checked, my relationships with the operators, was the strategy. Now, cash flow, I feel like in this market, cash flow is important. When you can, and it takes me back to my real estate mindset. It's almost like investing into a rental property that is giving you good cash flow. So that gave me some peace of mind before entering a new asset class where also like private equity, right? It's very difficult to get cash flow for most of or new developments. I like that. But you also have the upside of, for example, having a new drilling. You want to enjoy that upside. It's almost like investing in a new development next to an airport, for example. So the deal I'm doing is a good mix of the two of them, and naturally felt correct with the group, the timing, and the fund timeline was for 10 years. Also, a lot of it is to do with timing, right? So, for example, it depends that what deals have I been doing recently, what deals my investors may or may not have appetite for, right? So, at that point. So, of course, I got into this deal when it's been a slightly volatile time in terms of the trade wars and uncertainty in the market. But I like the fact that it was a 10-year hold. The target to exit in 5 to 6 years was a good 10-year hold, which allows you to walk through the different, move along the different volatilities and stay put and really be opportunistic in when you want to sell. So yeah, that's how I view it, right? Like end of the day, I'm investing my own capital to start with. So I want to make sure is that okay, and I'm transparent with my investors that this is all the due diligence done, these are all the reports, this is how I think about it, and kind of you take it from there.
You hit a couple of really cool points there, Nishant. Investing your own capital with your investors' capital. I'm generally the largest check in my deals. And hey, there is skin in the game for me, and that is confidence for my investors that, hey, this is a good deal to invest in. And second point that you hit on was the volatility. The markets have been extremely volatile over the last few months. Not only the stock market, but even the real estate markets. There's a lot of uncertainty because of the interest rate and so on and so forth, right? Given this all this volatility, a lot of our investors are sitting on the sidelines, are on wait and watch mode, and that's when they also have a regret later on that, hey, I should have put my money in here. How do you let our investors know who are watching the show right now had they that the time to get in is now? Or how do you convince your investors, hey, this is a good deal, not the time to sit on the sidelines? Talk to investors about that risk and reward, as well as why they should be putting in their money, making their money work right now.
No, that's a great point, Akash, and it's a real point, right? End of the day, and it's a valid point. There is volatility, and from from an investor perspective, no one wants to get in with the falling knife. What I mean is, really doesn't know things are going down. You just think it's going to keep going down before you don't know you're already at the bottom. A couple of things which help my investors make a decision is firstly, we take a long-term view. So we are buying at a buyer's market or when we believe we are nearing the bottom or at the bottom, you're anyway making a good decision because you're going from a long-term view. So we shouldn't be trying to calculate when is the perfect time. We should be looking at the macro elements and making a move accordingly. Point one. Point two is that I always emphasize whenever we even look at track records. When I was a real estate broker in New York City in 2020, by the end of the year, some of my purchases done by buyers were the best deals I've ever seen. And come in a year and a half, prices already up 10 to 15%. People are shocked. So I always let the investors know that look, 2 to 3 years from now, when you're in a more stable market, my conversation will be different for you. Maybe so higher cash flowing deal, I might focus on more new development. But at this point, it's a beautiful opportunity to be buying these assets and getting in with very low basis. And irrespective of what you're thinking of volatility, you have to bring it down to simplicity, supply and demand. What's happening in the next 2 to 3 years? We are going to be an undersupply market. No one can deny that. No one can change that. There's just not going to be enough supply hitting online. And that's that opportunity where we want to be. Would you at 2028 want to own assets in this place? I would love to. You want to be in that position of power, right? And once you make those exits, then maybe it's a different strategy for us at that time. So I always give the choice to the investors, always their decision. But I also let them know that, hey, this strategy may not be the best in 3 years. You have to see the market, you have to respect the market, and you have to take action where the market is telling you to do. So right now it's a growth oriented market. This is the best chance one may have to exceed your projected returns just because the market's supporting you. Maybe 3 years from now, it may not be.
You said it right, man. Hey, there is a lot of distress in the market because of bad deals done by a few operators in the height of the market. So a bunch of distress, and that is why you're getting properties at a very low basis. This time may never come, and obviously there is, also a supply crunch. Hey, there's a lot of population moving into the Sunbelt area. So over the next 3 4
Absolutely.
years, there's going to be a lot of demand for apartments. So I couldn't agree with you more. This is probably the most opportune time to get into the multifamily market, if you may. Nishant, hey, we are about time, but before we part ways, any few final words of wisdom to our investors here?
Sure. Well, firstly, thanks for having me over here. I feel like just listening to podcasts such as these, just get yourself more involved. I would say Akash himself is working as an operator in Dallas. He's working across startups, different asset classes, real estate, of course, private equity. Let's educate yourself. Get more involved, and at the same time, after a point, have that conversation, take action. Right. So I feel today's day and age, we're very lucky that we have good information, concise information now available in our fingertips, which wasn't necessarily true till 3 to 5 years ago. There weren't many great podcasts. You're only dependent on books, but now we have AI, we have social media, and different modes of channels as well. So educate yourself and take action.
Very cool. Thanks a lot, Nishant, for all your words of wisdom and advice. It has been a pleasure talking to you. I will take your information and put it on the podcast so that our investors can get together with you as well. Thanks a lot. I really enjoyed our conversation. Thank you, folks,
Thanks,
and
Akash,
that's a
for
wrap.
having me.
Thanks.